Okay, well, thanks everybody for joining. I'm going to actually have a few slides, and then we're going to really spend most of our time on the actual application showing it. But, a couple of things to keep in mind, and that is that, this is going to be an amazing year because for the first time in January 2016, if you think about, W-2s printing, for the first time, employers are going to be producing this form, and it's a 1095-C form. This is the brand new form that will be done. And we're going to go into kind of a little bit of a deep dive into what this form actually means for you and how we generate it off of our system, and you'll see it being generated. I don't care where you run your payroll, whether it's through Great Plains, in-house, outside. The ACA has brought new definitions to us. And if you look on the left here, you'll start seeing things like standard measurement periods, initial measurement periods, stability periods, safe harbors, rule of parity. All of those now have become in our vocabulary of payroll. You can't escape them any longer. The other thing is that an interesting part of this legislation has been that it requires for the first time employers with 50 or more full-time or full-time equivalents. Now, this year it's 100, but the law actually says 50 or more to provide affordable health care coverage. And it's never been done in this country before. And what it also not only defines the health care coverage, it also establishes a first-time affordability. In other words, how much an employee should be expected to contribute to their self-only coverage. So it's a legislation that's kind of interesting in that sense. The other thing too is that it's kind of going to change our looking at quarterly and yearly breakdowns is what we're used to in reporting. To the ACA is all about monthly breakdowns, so it's a little bit different. It gives us we now have to have a lens on monthly accuracy, and whether you decided, and I'm not going to get into it, but the pay or play strategy that you have, it's really kind of doesn't make any difference because you still got to print out these 1095-Cs. A lot of our customers, anybody with hourly paid workforces tend to have a lot more vulnerability to IRS penalties, and we're going to kind of go through that. Lower wage workers, part-time workers with varying schedules. These are kind of a fairly broad rules of type of employees that really have to watch it when they're talking about how they track hours, et cetera. And you'll see things like, colleges, universities, and schools. We have a lot of those using our application also. So to tell you about how this is all going to work is interesting. The IRS actually is the gatekeeper of the ACA information bundle. And you this year, when you're the applicant, when you return your print out your 1040s, you've got a new line in it. It's called line 61 for the long form, and that's you're going to tell the IRS whether or not you have secured coverage under the individual mandate, which is enforced this year for 2014. I'm going to mute. And then the insurance providers will provide to the IRS everybody who's covered. Every month, the exchanges actually provide the IRS, and this is your 1095-C. All of this gets into the IRS's, they call it the AIR system, the Affordable Care Act Information Repository. And what's startling about this is, as you can see, is that most people in this call that used to get a W-2 every year will now be getting a 1095-C from the employer, and if you were provided insurance, you're going to get a 1095-B for any insurance provider that covered you in any 1 month. So if you're an employee that changes insurance provider mid-year and you were covered partially in one, partially in another, you'll get 2 copies of it. And so all of this data gets into the AIR system, and I think the most startling thing this is right off of their, transparent webpage, is how much money they've spent so far in just collecting data. We are probably going to hit $1 billion in an investment, and they're on time. to get it. And people who think that this is going to be a calamity like the exchange was, and you got to realize is that exchange was managed by the Department of Health and Human Services, who really had no real big experience in data collection. The IRS has been collecting data for years. They know how to do it, and now it's a totally different ball game for them. So we do ACA reporting. When we looked at this system, we ended up looking at the requirements of it, and we do eligibility tracking, affordability testing, rehire monitoring. We're compatible with all versions of Great Plains. We actually have 2 customers still using version 10 of Great Plains for their payroll system. We consider ourselves the line that connects the dots for ACA reporting. And the other thing that we have is that we will do the e-filing, and if you have multiple companies in which you provide that you're processing payroll, you have a requirement if they're a common control or affiliated group to submit as one entity, and we'll go over that here in a minute too. This is who we are. This is kind of our history. We just kind of got into it, deep dived into this because we had some pretty big payroll clients, and they came to us originally and said, "Hey, look, this Affordable Care Act stuff is important. I need you to." I need the actual finalized submission for the IRS, in which we have now got submitted the form for our form for certification, which I don't think that's going to be a problem at all. So now let's dive into it. And I'm going to mute because I'm hearing some feedback. So I'm going to have to mute. If you're going to need to chat, you'll see there that there is a chat functionality here if you within the system. But I'm going to end up having.
Ernie?
Yeah.
Ernie, excuse me. This is Jody from DFC. The last time we got muted, it muted yourself as well.
Oh, it did? Okay.
Yep, so just making sure that you choose the option to mute audience, not presenter.
Okay, I got it. So that I'm going to test it out here. Did you hear me?
No.
Okay, that's fine.
So should we ask the attendees to maybe mute their line?
That's okay. I mean, I'm all right with it.
I'm not.
Just go through. It's up to you. Okay. This is the Great Plains GP 2013 R2 version. This is what you're used to. When you load our application on it, it's really pretty simple. We're just a chunk file that you load into the directory of the Great Plains. And what will happen is that you'll create this palette, basically. This is our code. And we don't really host a lot of information in our system. It's kind of interesting is that we really mine Great Plains data for all of our reporting requirements. And if I look here, the first thing you have to do is to set up our system really are these 3 areas here. First thing is ACA code setup. You just come in here and you grab whatever. You just tell us what pay codes you use in order to determine to track hours. And you'll also see here that we have things like salary will also be salary people are also included. And the nice part about Great Plains is that it allocates the 40 hours a week per salary, which is exactly the guidance that the IRS has given us. So everybody's hours are actually tracked in the ACA world. You have a requirement to track everybody's hours. And the good part about Great Plains is it automatically does it for salary people exactly the way it should be. But you're seeing here sort of a different concept. We're kind of used to hours of work, and that's where, a classic example is I punch in, I punch out, that's hours of work. The ACA is about hours of service. And in hours of service you'll see that I've got things like jury duty, non-paid credited hours. There are 3 mandatory hours of service that you must credit. You don't have to pay somebody you don't have to pay them $1, but you have to credit them their hours. And the 3 are as follows: jury duty. I don't care if it's part-time or full-time. If you don't pay, if somebody goes on jury duty, you have to credit their hours. You have to credit them. And the nice thing about Great Plains is that it allows you to create pay codes that have $0 associated with it, but you track time. The second one is FMLA, and you'll see where we handle FMLA two ways. It's easy when you have a person saying, well, I'm going to take 4 weeks off. That's a start and end date. But I can also do FMLA where I could tell you, you know what, I need therapy on my shoulder for 3 hours every Thursday for the next 4 weeks. You have to provide me access to that therapy. You don't have to pay me, but you do have to credit the hours in there. The third one is military duty. If you have somebody who's on military duty, you credit them their hours, even though you're not paying them. Those are mandatory in the law. There's a third one that's an interesting one. That's short-term disability. And if somebody is on short-term disability, they're probably on FMLA too, but they don't necessarily have to be. And the problem with short-term disability is there's two ways that's handled. The employer provides short-term disability, or the employee can get it on their own. AFLAC's a classic example of that. So what we do is you just tell us, what pay codes you use to pay your employees and track hours. Once you've done that, you created this report. We are able to populate this report. And I'm going to use 2013. And let me just print out this, and I'll explain this database group here in a minute. But you'll get this report. And if you looked at the 1094 C, which is this transmittal for the 1095, you'll find that this is pretty much the type of data that you need to provide. You have to break down by month all your full-time and full-time equivalents. And the way we do that is here. If you look at full-time, it's pretty simple. If somebody, and this little area, I don't know why somebody removed me. Let me go back here. If somebody is designated as being full-time, you must provide them access to health insurance within 90 days maximum of their start date. And that's kind of important concept. It's actually, believe it or not, that's not really true. That it's the first day after the first full 3 months of employment. So if somebody, and you won't get penalized if you provide health care by the first day after the first 3 full months of employment. So under the law, if you hire somebody June 2nd, really you don't have to provide them health care. You will not be penalized if they are provided coverage as of October 1st. Because June, July, they wouldn't have worked full months in June. It would be July, August, September. October the 1st is the same. But how we got those reports is if I look here at the employment type, this has a lot of meaning for you now. If you reasonably expect somebody will work 30 hours a week on average, they are considered full-time, and they don't have standard measurement periods, initial measurement, they have waiting period, and I just gave you the rule for that. However, if you have an employee that you don't know whether or not on average they will work 30 hours, you will then consider them to be a variable hour employee. And to us, a variable hour employee is really a part-time employee. And what you're going to do is you're going to test them to see whether or not they do indeed make the cut of how many hours that they will actually work. So this is an important thing now because what happens is that designating somebody full-time puts you in an obligation to provide health care coverage immediately. Part-time says, I'm going to look at them over a measurement period. So let's go to that right now and show you that. So I have standard measurement periods. And it's interesting here is that the law has two ways of measuring people. The first one is the monthly measurement way, and I'll just explain that. It's pretty simple. Anybody in the ACA world, any employee that works 130 hours in any 1 month of the calendar year is considered to be a full-time employee. And if you're using the monthly measurement period, what would happen there, you would say, the guy worked 130 hours, I've got the first day after the first 3 months of after that, I've got 3 months provide him health care coverage, and then he's in a stability period for at least 6 months. And if in that time he then has 130 hours in another month, it just kind of kicks that stability period down the road. But when that first came out, I mean, there was an uproar because a lot of people say, you know what, I could have a guy work 130 hours in 1 month and he could work 20 hours in another month. So what happens is that they created what's known as a standard measurement period or measurement periods. And in this case, in our system, you can create as many as you want. You can segment them by hourly or hourly, and you can actually have different ones by state. And you could start the measurement period using the hire date or using the first day of the next month. Most of the people use the first day of the next month because one of the caveats is that most insurance start at the first of the month. And if it doesn't make any difference because you're not credited with providing somebody with coverage for a month unless they were covered every single day of that month. So what we did here is we created a standard measurement period of January, 12 months. This can be as low as 3 months. It cannot exceed 12 months. And then we created an end date, and then we had an administrative period. In our case, it's 1 month. This could be as much as 3 months if you want for a standard measurement period. And what happens here is that I'm going to test my employees who work this entire cycle. And I'm going to see at the end of the year when I finish processing payroll for this date, that covers up to this date, what I'm going to do then is I'm going to test them. And if they passed, and it's a pass or fail grade, then I have this administrative period time to notify them, offer coverage, and if they elect coverage, to sign them up so that they will start coverage on this date, and they will be provided coverage, access to coverage during a stability period, no matter how many hours they work in that stability period. So this is once you pass this, you accept it. You're going to get coverage during this period of time, access to cover during this period of time. So that's a standard measurement period. The rule is in order to be in this, you have to have worked this entire. So you had a period. You had to have been employed as of this date, and you had to continue to be employed as of this date. And so what's going to happen in your world is you're going to constantly be testing people. So somebody could pass this one and fail this one, and you'll be able to drop them their coverage if you want starting this date. So let's go and see how that actually works on a reporting standpoint. If I come here, I can create a standard measurement period. I tell them, okay, you know what? Here it is. I'm going to use that standard. I'm going to use 12/31/2013 to cut off, and I'll just go to this using this company, and I will hit print. Boom. Here it is. This is the final determination of eligibility based upon the Affordable Care Act requirement. And anybody that's full-time here is required. The magic number for a 12-month is 1560 hours. With our solution, we have this capability. Originally, most of our reporting was actually done out of Excel, but we did the same thing. We allowed you to. It looks at your standard measurement period. It looks at your period, and I'm going to do something different here. I'm going to put 03/30/2013. So you can use this to forecast that, and here I'm forecasting who is on trend to be full-time or not. Let me just look at my part-time people because I want to show you something interesting about periods of time. I said that I could have up to a 12-month measurement period, but I could have had a 6-month measurement period. So if my measurement period had been from January 1 to 6/30/2013, these would have been the number of people that would have been eligible, part-time employees that would have been eligible for coverage. But what happened if I create a longer one? You will see that list gets much shorter because they had to have worked the entire time for one thing, and you're averaging statistically the higher the level it is, the higher it is, the more kind of accurate it is. So most of our customers actually are using 12-month standard measurement periods. So that's this report. So what happens, though, is that when somebody, if you remember the rules of a standard measurement, the rules of the standard measurement was that they had to have worked during this entire cycle. But what happens if somebody started February the 2nd, 2013. Well, they won't be tested here because they wouldn't have been in there. Does that mean, but they will be if they continue to work, they will be tested here. Does that mean that they've got to wait 23 months to determine eligibility? And the answer is no. What happens is that everybody gets, if new hires get what they call an initial measurement period. And this is where monthly reporting is critical, because all of your new hires are on a monthly initial measurement period. And it looks a lot like the standard measurement period. The difference, though, by the way, is that the combination of these two, the initial measurement period setup and the administrative period, cannot exceed 13 months. Whereas in a standard measurement period, your initial measurement period could be up to 3 months. And the theory is that in standard measurement periods, you're testing thousands of people. Initial measurement period, you're just testing the new eligibility for that month. But this is where monthly reporting comes in. So this is based upon their hire date. You see no start and end date here because it's all tied to their hire date. So if I come here to report on this, and I'll look at my initial measurement period here, and let's do the same thing. We're going to do 12/31/2013, and I'm going to print. Screen, boom. This is what you get. Now, this is a forecasting, what tells you who your new hires are, and as you can see, our hire date of these people is after this date, what month they're in their initial measurement period, whether or not how they're trending. The same thing. Now, I won't have anybody with 12 months here because I used 12/31/2013. If there were 12 months, they would have been in my standard measurement period. But this gives you an idea of forecasting of that. I have 14 people out of 117 that are forecasted to be will be full-time in people. Again, we have that exact same report available here in our Excel add-on, our Excel dashboard. So this is kind of forecasting. But every month I have to run this one. And what this tells me is in that particular month, and I'm going to use 03/31/2014, in this particular month, these people completed their initial measurement period, and how many of them are full-time, made the full-time. So if you think about a minimum reporting, you can use our reports to track risk assessment. But at a very minimum, you must print this out at the end of that period, the testing period, and this report has to be printed out monthly. So those are the two. This is probably the more critical one on an ongoing basis because it's the new eligibility requirements. Remember, when you're talking about ACA world, we're not talking about check date anymore. Nowhere in the ACA is a check date important. It's all about these dates right here. And when you period from and to, you have a couple of different ways to do that in our setup. When you go to company setup here, you'll see that we will ask you, how do you want to credit hours? Do you want to spread over the pay period? And what we do is there's an algorithm that we use to spread it into the months. You can use the first day of the pay period or the last day of the pay period. You have to be consistent, though. You can't change it from one to another. The other one we have is waivers, and tracking of waivers. Now, this is really actually not mandatory. All of us, by the way, are getting to this. What we're trying to do is get to this form right here, and I'm just going to print this one up for this one person. This is the form that everybody is looking at, is printing this form. Really important something here. It's about offers of coverage. This form is not going to be used by the IRS to determine whether or not you got health insurance, unless you are self-insured in the pure sense. Because I've actually written my senator and my congressman and say the requirement for ACA tracking for self-insured people, companies, is crazy because nobody is truly self-insured. If you've got a stop loss with a high deductible that these people, because it's going to be administered usually by a insurance carrier, they're going to get the 1094 B anyway. They're going to get a 1095B from the insurance broker carrier. But what's happening here is the 1095C, the purpose of it is to track whether you offered coverage. And so this is what type of coverage you offer and the employer's share of the lowest cost monthly premium. Sometimes you will have that, and I'll show you when that happens. And if you're using a safe harbor, it is not to validate whether or not that individual actually was covered. That's to be done. This is about you offering coverage. And your offers of coverage and the employer's share of lowest cost monthly premium may not actually be the plan that employee is enrolled in. Because here's the standard. If you had 3 plans and you had like a bronze, silver, and gold, and the bronze plan met minimum value, it's your lowest cost plan, that is the plan that your affordability is tested on. If the employee selected a higher level quality coverage, maybe a lower deductible, that may have taken them out of that affordability standard, you will not be subject to a penalty because you offered them a lower cost alternative. It's about offers of coverage. So let's go into that and show you how that's done. You see this benefit, you've got benefit codes for coverage. From there, what happens is that we go into our plan setup, and this is where we kind of talk about the attributes of plans. And this is actually what dictates line 14 and 16 and whether or not any information will appear. And is it a qualifying offer? Does it provide minimum essential coverage, minimum value? We have a very large customer that's a national temp service that is only providing minimum essential coverage. It will not be minimum value this year. But these are done. They're going to get hit with a penalty. They know it because they're providing minimum essential coverage, so they're not going to get what we call the sledgehammer penalty for not providing coverage. But because they're not providing minimum value, they will get for anybody in their who received a subsidy on the exchange, they're going to get a monthly assessment. It's a yearly assessment broken down, and I think it's $3,100 this year divided by 12 for every month. Anybody that got a subsidy got coverage and received a subsidy on the exchange. They're just going to get a bill for that. But a qualifying offer is sort of like the catbird seat. That is an offer of coverage that provides minimum essential, minimum value, employee, spouse, and dependents can be on it, and it's using the federal poverty line safe harbor, which this year, by the way, this self-only cost, that's what the employee pays. If it's under $92.97, it's considered a qualifying offer for this year. Now, interesting about the law was that it was written, I always say that there's 2 types of legislation. There's good legislation that really deals with a sound, problem in a sound way, and there's other legislation that's written just to get the votes. And that's this is in the second one. Because believe it or not, when it came out, it says that affordability standard is based on 9.5% of the adjusted gross income of the family household. Well, your employees don't give you 1040s, their 1040s. So what they came up with is these safe harbors. The first one is the W-2 safe harbor. Basically, if you click on this, you're saying that I cannot exceed 9.56%. By the way, this percentage changes year to year. This year it's 9.56% of the Box 1 gross wages. So that's a pretty simple one. It's W-2, Box 1, 9.56 is the maximum. The problem with that is that if you're in an industry in which you have schedules that vary and you can't really control that, if you have an employee that was in a standard measurement period, averaged 130 hours, and then they got into a stability period, and let's just say for some reason they're only working 10 hours a month and they're $10 an hour, you would have to provide them affordable coverage for $9.56 a month. if you use the box 1. Interesting also about the box 1 is that it sets the maximum of 9.56%. Nowhere in the ACA law does it talk about a maximum of the cost of the employer. So if I'm a $100,000 person, I could, in my box 1, my employer could charge me up to $9,560 for coverage. It may only cost him $6,000 to cover me. There is nothing wrong with it. That is not precluded in there. I think that if that ever got out, there would be another issue. But the W-2 income is pretty straightforward. Box 1, 9.56% this year. Rate of pay is the one that most people are going with. And the reason is that as you start looking at living wages and that, what it says is that if I, in a standard measurement period, worked 130 hours, I should reasonably expect to work 130 hours in my stability period. So the rule here is I look at, if a rate of pay, I look at what the lowest paid, what the lowest hourly rate wage was for that worker on the planned start date, or if in a month that worker's wages went down for that month, that hourly start rate, times 130 hours, times 9.56%. And that is the rate of pay safe harbor one. So it's tied to the individual's hourly wage. A misconception there is people say, well, that should be the lowest wage of the worker, of a worker in that group. That's not it. The reason why people do that is I consider it the poor man's way, because the theory is that if I use like the state minimum wage, I know nobody's going to be below that. But it's really tied to the individual worker as a maximum that you could, the wage rate of an individual worker. The federal poverty line is based on 11. It's based on the single mainland level for this year. It's $11,600. And that's, you times that by 9.56 and divide that by 12, and that's where you get your $92.97. So these are the safe harbors that you have the ability to use to monitor that affordability aspect of the law. And then on your box 16 of your 1095C, we populate it based upon how you set up your this screen right here for that is. As you can see here on one screen, on one of these, we said it was the least cost plan. And that's the one that everybody that you're going to be measured your affordability on. So if somebody doesn't offer, again, if somebody waives coverage, doesn't want it, you only have to offer coverage. They're on no obligation to accept it. But you still have to produce a 1095C for them. You will say that I offered coverage at this amount, at this line, at this level. They were offered that coverage. You will also tell them, box 16, they won't have a 2C there. They will have a 2H, meaning that they you use the federal poverty line safe harbor for that, or whatever this is. So even if somebody doesn't get coverage or they refuse it, you still are printing out a 1095C for them. So let's talk about waivers. Waiver codes, and this is where it kind of gets. When you do our year-end closing, we're going to ask you a couple of questions. And one of the questions we're going to ask you is that, is your lowest cost, will you certify that your lowest cost offered was offered to, for this year it's 70% of your eligible employees. It's going to go up to 97%. If that's the case, you may not have to worry about waiver codes if you don't want to. Because if you're offering it to everybody, the assumption that we will be making is that you did provide an offer of coverage to everybody. We have some clients that are in fast food industries. They have way too many employees. One of our biggest clients, their corporate goal this year is to try to get attrition under 600%. And they're saying, you know what, we're offering coverage to everybody. We can't track people for waivers. Assume that we have an offer of coverage to everybody eligible, and that's okay. But if you wanted to track waivers, you could do that. And one of the things that we say we allow you to do is create codes. As you can see, I created 3 codes here: parent, refused, and spouse. these three have different meanings. Refuse is the one I'm going to talk about here in a minute. If I am in an initial measurement period, and this is an important concept, if I'm sitting here and I said, yep, I want it, you were tested, you are good to go, and I come to you in this period and I say, I don't want that coverage, I refuse it, you are in no obligation to provide them open up coverage during this period, stability period. If I tell you, though, that I'm covered under my spouse, and let's just say in June my spouse loses coverage, that's a life event. And most insurance carriers, they can open up coverage for that particular, or the parents, and they turn 26, or they lose coverage. Interesting to note about waivers. If I waive coverage, I'm only waiving it for this period of time. If I am tested again, and I again am eligible for coverage, the previous waiver is null and void. So you have to get waivers every year if you want. If you're opening up coverage, you open up coverage every year. Somebody said, I don't want it the first year, and they were eligible again, you still have to communicate to them the eligibility. And by the way, the eligibility communication could simply be a letter. I think that you've seen them, the IRS's letter on that, of just informing somebody that they are eligible for coverage. This is one of the things that we do for that. This is our dashboard, and I'm going to one of the things that brokers have wanted, the insurance industries want, is they want monthly feeds of your data now. And this is the one that we do, and we just say, give me everybody as of the 12th. We highlight everybody in here, and then we tell them, we give you their name, addresses, blah, blah, blah. In this case, I'm going to select all. We tell you how they got coverage. They were a full-time employee. They terminated this month. They were assessed. They got their coverage through the standard measurement period, whether they're eligible or ineligible, and if they're eligible, what their stability period is of eligibility. So as you can see here, this person here worked 2246, 1726, they're eligible. This is their stability. They're in their stability period. This person was not eligible. They're ineligible. So we tested them in a standard measurement period. They're ineligible, and we go on and on and on. And as you can see, I had originally only said I just want to see people in my standard measurement period, my initial measurement period, and here they are, who passed and who failed. And if they passed, what their stability period is. And a lot of our customers use this to send to their brokers if they require for coverage notification. Okay. The last thing I'm going to talk about is dependent information. If you're not self-insured, okay, so if you're not self-insured, you don't need to worry about dependent information. You don't have to keep track of dependent information. If you're self-insured, then you do have to keep track of dependent information. And in this case, what you need to do is get dependent name, the first name, last name, are they a spouse or not, there's either the Social Security number, the birth date, when coverage started, and if coverage ended. If you have a start date of 06/01, let's say 2013, and no end date, we assume that it's ongoing coverage. Interesting part about this is that all you need is this to tell us what month. We know by these dates what month somebody was covered, and in a lot of cases, this information could be uploaded directly from your carrier because your insurance provider has the same information, and most of them will provide you a spreadsheet of people that are covered and their dependents, and you can just upload it in here if you want. And that's only for self-insured. If you're not self-insured, you don't have to worry about this. I'm hoping that this goes away. To be honest with you, I don't think it's necessary because they're going to get their own reporting anyway. We also have a couple utilities here, and the first one is that you saw where I had that now employment type means a lot to me. And I'm going to just run this and say these are people that I have that are full-time people that, based upon their activity, really should be part-time. And remember, if somebody is tested, if you've got somebody who's part-time and they qualify for ACA, you don't change them to full-time. You keep them as part-time because you're going to test them again. When you change somebody to full-time, you create a totally different obligation of coverage. So this person right here, these are people that we had a customer who talked about $36,000. They never used that employment type. And so they came to us and they said, look, I can't change that. Could you do it? And what we would do here, the only time we ever change Great Plains data is if you came in here and you say, change all of them and process, what we will do is we will come in and we will actually change adjustment hire date to that, we would change them from full-time to part-time. The adjustment hire date is the next one, and is the next one that we have, and that is the rehire utility. Rehiring, the ACA, it's an interesting, throughout the ACA you hear non-discrimination, 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 non-discrimination. I mean, everywhere. If you've got a plan that, is traditionally been only offered to office workers, not to hourly workers or factory workers, this is probably the last year you'll be doing that, because the only thing the IRS has not done is announced when they will start enforcing the non-discrimination ruling for plans. So we're getting to a point where plans are going to be offered to everybody. And you're going to want to do that because the penalties for that are pretty severe. It's $100 a day per discriminated employee. But those rules are not, it's written in the law, but they haven't, said that it's going to be enacted. But what we could do is, but one area that was kind of interesting and allows you to totally discriminate is that's on rehiring. And what the rule is that if an employee, any employee is absent for 13 consecutive weeks, you can elect to classify them as a rehire upon return. And all that means is that you take them out of a standard measurement period and you put them they put them in their own initial measurement period and they begin testing again. The danger of that is if somebody was absent for 13 weeks, you have to think, if I just didn't consider him rehire, he's going to be tested in the standard measurement period. They may not make that 15, 60 hours. So I'm just not going to consider them to be a rehire. It's totally up to you. The second thing is what they call the rule of parity. So if somebody previously worked for you for a minimum of 4 weeks, and their absence of service was greater than what they previously worked for you, you can elect upon their return to reclassify them as a new employee. So I worked for you for 4 weeks. I was off for 5 weeks. I came back. You have the ability to classify that person as a rehire, and as such, you start their initial measurement period over. If I had worked for you previously for 5 weeks, and I was off for 4 weeks and came back, I can't consider you to be a rehire because your absence of service, period of absence, was not greater than the period that you previously worked for me. And we're testing people out on this because we have a lot of temporary service companies that use ours. In that business, you got a lot of people that they'll work for multiple temp services, and what will happen is that they'll work 4 weeks, they'll be off for 6, and then they come back for 4 weeks, and then they'll be off for 8 weeks. And so you may have throughout a year multiple ones of these rules of parity where you can start classifying them. The interesting part about the rehire is I could have 2 people. I could have had one person, they both start the exact same day. They both left 4 weeks later the exact same day. They came back 5 weeks later the exact same day. I could elect to have one of them be classified as a rehire, the other one not. It is totally at your discretion whether or not you classify somebody as a rehire. Again, it's the rule of parity. It's either 13 weeks or if the rule of parity, if they previously worked for you for at least 3 weeks, were off for a greater period of time than what they previously worked for you, you could use the rule of parity to do that. The other, you saw the forms printing out for the for the 1095C. We will actually generate also the e-filing for that, but we also have some employee reports, and one of them that we do is this one. I'll just do this for 2013. Print to the screen. Boom. This tells you the employees how many what their hours of service were for ACA tracking in that particular month. Inside of our HR employee master file, we actually also have added two new things. One's a monthly breakdown. So if I look at this person here, this will tell me the year how many hours of ACA they are working. The other one is that if you need to edit for some reason the 1095C, you can come in here and do that. If you click edit on here, we know that you edited this month. So let's just say that you're regenerating, you didn't have something right in the plan setup. You did a year-end close. You can come back and do a year close. You'll see when you do our year-end close, we're going to ask you, do you want to overwrite edits? And if you click here, yes, we'll override those edits. However, if you said no, we won't. If you edited that for some reason, we won't override it for you. We also will handle the transition relief for non-calendar year plans this year. The other thing I have is group database setups. If you are processing payroll in more than one Great Plains company, and you're in a common control group or an affiliated group, and that's the affiliation is the one that gets you, you must submit as an entity. So all your determination of how many employees you have, if an employee is shared between two entities, it's the total of those hours that actually determines eligibility. So you can't sock away a guy at 20 hours a week in one company, 20 hours a week in another company, and say, well, he's not averaging 30 hours. Oh, yes, he is. And our reporting allows you to do that. So what you do, I have two set up. I have an ACA2 group. I always say, set up each individually, and then I create a combined group that included those two. So if I'm running this report, I'll just run the one report on ALE determination for 2013. If I look at the two company, you'll see that it runs through here. Boom, goes to the screen. Here it is. I have 267 employees just with 2 Inc. If I run as a combine both of them, and I hit print, the screen, you'll see that now combined, I have 415. The number would be 415 for the IRS if these were when I reported. I reported this number right here. Any questions? There's a lot of information that we kind of went through. There's no such thing as a dumb question in the ACA world. We're all pups in a kind of rudderless ship at this stage.
This is Mike. Oh, go ahead, Kathy.
Oh, sorry. This is Kathy from Easter Seals Goodwill. I just have a question on there's setup in Great Plains on the benefit side where there's a couple of windows. Do you overwrite that, or is that part of your reporting?
No, if actually in benefits, if you're using the Great Plains HR, if you click on this, what will happen is that we will, if you are self-insured, we'll take that information and populate these tables during our close.
Well, we're not self-insured, but yeah, there's those. If you have the, in the benefit setup, in Great Plains, there's those two things about. I think it's those 2 H's or whatever. It's if you offered them and if if they refused or you're safe harbor.
We don't look at any of that stuff.
You
we
don't.
do for the waivers if you do that, but we don't really look at that because if you're not self-insured, what it is in order to have coverage, you have to have a transaction in a paid transaction for the benefit that says that I was covered, and that's based on your benefit code right here, the benefit. And so what will happen is that as you're processing it, people have populated the W-2s, through this method too, is that you can, in our system, actually at the end of the year, import in a transaction that would attach this benefit code to that employee with a start and end date of the first day if he was covered for that year, the last day they were covered for that year. And then we would know then that they were covered during that time. We don't really look at, I know what you're looking at in the Great Plains side of the house, the 2 H's and all that. And again, I'm not going to criticize Great Plains, but the problem with that is that it's not based upon what they signed up for. It's based on your least cost plan.
Okay, well, understandable. So how does your data pull that information for the 1094 and the 1095?
Okay, what we look at is this. We will look at a transaction in the history file for that benefit for that month that would include that month for that employee. So if I know that they're covered, if I have a transaction for one of these benefit codes for that employee for that month. Now, I don't have to necessarily, and the tricky part is some people will include the benefit every time they run payroll. Other people may say, no, I'm just going to import it, or I'm going to do it once a month, once a year. Well, I would just put in one transaction with a transaction date here of the first day of coverage that they were covered and the last day of coverage. That code, you put it in there, and we know based upon the rules that that person was covered during that period of time.
So you know they were offered. What about if they're refused?
We don't. If they refuse coverage, you have two options in our system. The first one is that, and that's a great question because you get into a situation where how much waivers do you need to do? We know we have these waiver codes that we allow you to set up, or what we could do is Great Plains has it. No matter, we created a kind of a simpler way of doing it. But remember this. In the IRS says that there's no code for a waiver. There's a code for an offer. If you offer coverage and you offer that coverage to all your employees, you can assume and that they were all offered access to that coverage. You have the option, if you want to really keep track of it, to keep track of waivers. That's great for you probably, but for a fast food industry or for a temp service that has a lot of transaction, they're not going to track down people. What they're saying is that, you know what, I don't care. I'm not going to keep track of waivers in your system. Assume, and you can do this, that you gave the people had access to this coverage who was eligible. And what they do is they print out, they actually use our tool for the initial eligibility. They sent letters to people and emails to people saying you were eligible for coverage. That satisfied the requirement of accessibility to coverage. So
thank you.
You can do it one of two ways. It depends upon how much control you want. But you've got certain industries that the attrition rate is so high, they say assumption. Our temp services, they say, you know what, assume everybody is access. We're going to send them a letter. At the end of the standard measurement period, they actually used this to generate a letter, a mail merge, and they sent letters to everybody, and they emailed some of them too. And so they got offers of coverage that satisfies the offer of coverage for requirements for the IRS, that you did communicate an offer of coverage.
All right, thank you.
Okay, next.
This is Mike from DFC. On those hours, when you're reporting hours, you're going by the pay period dates that get inputted into the transaction entry window. So with that being said, if somebody's has a biweekly pay period and their pay period is from, March, 25th through April, 7th or whatever it comes out to be, in that window to accurately report month by month, does that mean that when they're entering in those transactions, they have to split it up by month?
Not at all. In fact, you should, we don't think you should be doing a whole lot of changing that. See this when we set up the company setup, we give you these options, credit hours based on spread over the pay period. We actually will spread that over, and the IRS provide guidance to do that. You could actually
Okay, so it's like a weighted average, kind of like how you
exactly what it
do
is.
year-end.
You hit it. Bingo, it's a weighted average. But you can also have the opportunity to do first day of pay period or last day of pay period, as long as you're consistent.
Okay, thank you.
Any
This is Kay at Valley Queen. I'm just wondering where the lowest cost coverage field, how is that populated? I'm assuming it comes from the insurance codes.
Yeah, it's right here. One of them has to have this checkbox. That's your least cost plan. And you can only have one.
All right, so if an employee has family coverage, still the lowest cost is self-only.
Yep. And that's
I'm
a
just
good
wondering.
question. Let's talk about you have a exceptional question because what's going to happen is best practices, and the reality is that a best practice in deduction is to get into the habit of separating an employee's coverage from his family coverage. And the reason is depending upon the safe harbor that you're using, like the W-2 safe harbor is the one. Remember, that will change by employee. The rate of pay safe harbor may change by employee. Your determination of eligibility and what you submit has nothing to do at this point with what you charge an employee for his family coverage. It does only about your relationship to providing self-only coverage. So, with that said, I believe, and the problem is that if you're using a certain safe harbor and you're underneath it, you're going to report one number. But going forward, you really should think about separating your insurance deductions between single coverage and family coverage separately. It will open up, you'll be able to hit any scenario that you have. If you have a W-2 safe harbor, you're going to have to do that, because their costs will vary based on their income.
Okay, thank you.
It's interesting. That's a great conversation because, people. And again, I'm apolitical on this thing, but the Kaiser Foundation, Family Foundation, is probably the biggest source of credible information on the ACA. And in 2013, the cost of coverage for employers for employees was the lowest rate hike since 1961 as a percentage for employee coverage. And that's the reason, because affordability testing is based upon the employee. Well, guess what happened? The cost for dependent coverage rose significantly because insurance companies know that their affordability standards don't apply to family coverage, and they're sucking the increases into that area. How long they're going to be able to do that, and the IRS pointed out that they would monitor that, I don't know. But right now it's only based upon affordability of coverage for self-only coverage for just the employee. Any other questions? Okay, so we're about out time anyway, so let me just go back here. You know who's going to produce a 1095-C? For 2015, every employer with 100 or more full-time equivalents. You actually must file electronically if you have over 250. Starting in 2016, that goes down to 50. And if you're self-insured, regardless of the number of employees, you must produce a 1095-C. Who's going to get the 1095-C? You'll see anybody who works 130 hours in any one month of a calendar year, or any employee that was employer-provided health care coverage, regardless, even if they did not work 130 hours. Remember, it's all about hours of service. These are times that you must include now, type of things that you have to begin to credit people's for. We've got some educational resources if you want to get that. We have a really kind of cool quiz if you want to know how much if you want to know, and these are fairly good questions that aren't, trick questions. They're pretty common. But you will see, you could take our quiz here to just kind of give yourself a test drive on that. And then we have some reporting clarity videos that we have. We do webinars once a month for our partners and customers, and basically we're trying to educate people. I know next week it's about deep diving to 1095C and exactly what that means. Cost-wise, we have two options. The first one is that if you provide payroll, if you're only using one company to do payroll, it's $2,100, and you'll get everything you saw today, including the 1095 and e-filing capabilities. So this is a $2,100 one-time fee, and then you have an 18% annual enhancement, much like Great Plains does. And it's mandatory the first year. You'll probably want to always pay the $378 because this law is changing fast. If by chance you process payroll on more than one Great Plains company, you will need to also get the ACA database combiner. That's another $1,200. So a total for somebody that does both Great Plains on on multiple companies, the total cost up front is $3,894, and then subsequent years 18%. And it gets $500 a year for. That's what I've got, and your partner there is a good partner, and they could steer you in the path of generating the 1095Cs, electronic filing. It's the reality of the new millennium. And as you all know, today the Supreme Court's hearing arguments on the state exchanges, the wording about state exchanges.
Okay. Well, thank you, Ernie. And then all of our customers out there, thank you so much for attending. Jody and I will be contacting you guys to see what your thoughts are, to see if you want to get pricing. He already gave you pricing, I understand, but maybe you want to move forward, or maybe you have more additional questions, that type of thing. If you prefer to, yes, I've definitely got questions, you can go ahead and type them up, and if you know which one of us you work with, go ahead and email them over to us. Otherwise, you can expect a call or an email from Jody or I.
Yeah, I ended up getting I did get one question from somebody, and I want to explain that. And that person was talking about having multiple. They did a chat, and I think I understand that they have three different coverages. So they have like a high deductible plan that is the least cost, and then they have a couple of other ones. If somebody elects not to have coverage, again waived, you're going to report that based on the least cost. Also, if they elected different coverage, everything's based on your least cost option, value standard, on affordability. So it's very common that we have customers that have multiple types of plans. The key is that one of them, the least cost plan, and that's the one that's affordability is measured on.
Bernie?
Yes.
This is Darla Gravinger from Missouri Center.
I can barely hear you. I don't know.
Are you there?
Yep, I'm there now.
Okay. This is Darla Gravinger from Missouri Slope Lutheran Care Center. And we are the ones that ask the question. We have 3 levels, and it's based on their guaranteed hours that they work for us. And I understand that, it's the 30-hour per week, but we still piece people in based on their guaranteed hours. Now, speaking from that aspect, which one of the rates would we use?
Okay.
Because if they're working 36 hours a week or more, the amount that the employee pays is the lowest dollar amount. But if they're only working 24 hours a week for us, they're paying a little bit more.
Yeah. You've got a great, the question is applicable, and I'm going to give you the bad news. Here it is. And we I'm just a messenger. Let's look at this. Your rate of pay has absolutely nothing to do, your safe harbors, of how many hours they actually work. Eligibility determination, you have to separate the two. I'm eligible if I work 30 hours or average during a testing period. Therefore, you have to provide affordable coverage. So you have three options. Forget about how much I'm deducting. Maximum I can deduct. The maximum I can deduct is based upon the safe harbor, which, if you think about it, is nothing to do with how many hours they work. It has to do with income. First one would be W-2 income. That is just 9.56% of their wages for that month. I mean, when you set up in Great Plains, you just tell it's 9.56%. That's it. That's the maximum. If you say, or for that year, if rate of pay, it's their lowest monthly. It was the lowest hourly rate at the start date of the plan times 130 times 9.56. That's the maximum you charge them for health care coverage and be affordable. Federal poverty line, it's $92.97. That's affordability. That's it. If you say if you think about it, you're not using any of those. And
okay, so what you're saying is it's whatever we calculate. That's the dollar amount that goes in that least cost of the plan.
Yep.
Not whatever our deduction amounts are.
That's right. It's the employee's contribution to for their self-only coverage. Many cases it's a constant. Like in this case, I said for the 2013 was $110. You'll be reporting that as $110 if that's a standard, a stagnant across the board coverage. And usually health coverage start and stop in a planned year. You know what the individual self-only coverage is. But that's very different because you asked a really good question, because that doesn't mean that it's affordable. That's just a deduction that you gave, that you're doing. It may not be affordable. And in that case, if the employee does go out and get goes to the exchange, gets a subsidy, and it's shown that you did not offer affordable coverage, you're probably going to get a letter.
I think we understand.
And that's the tricky part about this whole legislation. It's not that you have to offer coverage; it's you have to offer affordable coverage. And the penalty for that is different. That's only based on the number of people that received a subsidy on the exchange. You're assessed the penalty per month on that if it's deemed unaffordable.
I think we understand it now, Ernie.
That's why the rate of pay is the best one, because you can figure that out. It's guys, $10 an hour. It's times 130 times 9.56%. That's the maximum you can charge an employee for their coverage. What you elect to charge is totally different, but that's the maximum you can charge to avoid a penalty. Because remember, in my slide, there are two penalties here, and you'll see them. There is the sledgehammer penalty, what they call it, and that's for not offering any coverage. And so it's $173.67 a month. You would be stupid to get this thing, because you can buy a lot of minimum essential coverage for $173.67 a month. And in fact, many of our customers that are only providing our national temp service, they provide minimum essential coverage that costs them absolutely nothing. Because the employee bears all the responsibility, because they said, I'm going to provide coverage. I don't want the sledgehammer, but I'm okay with the tack hammer. And the tack hammer is a different penalty, and that's where I'm providing coverage, but it's not affordable. In that case, that's where it goes over those safe harbor limits. In that case, this one is to all full-time employees. This one would be only applicable for those employees that went on an exchange, got a subsidy on the exchange, that would be assessed on them. It's a $3,100, I think $67. It ends up being about $200 some odd a month per employee, but it's a much smaller reduced set because it's only applicable to people who went on an exchange and got coverage and got a subsidy. Not the sledgehammer, which is all full-time employees. And that's why you break it off into two: affordability, accessibility, and then affordability. And there are two different penalties associated with that.
Okay. Thanks, Ernie.
Okay. Any other?
So.
Okay. Well, thanks a lot. I appreciate the time. We ran about 12 minutes late, so thanks for bearing with us. Bye-bye.
Thanks, Ernie. Thanks, everybody. We'll be in touch.